The screens are bright green today, but this relief rally is running right into a wall of systemic risk. While geopolitical headlines provide a temporary lift, a massive divergence is forming. We're seeing a deep split between stock market optimism and the reality of confirmed tech layoffs, labor revisions, and a deepening credit cycle. Today's rally is being driven by a significant geopolitical pivot. According to Joseph Carlson, the U.S. is prepared to exit Iran within the next 2 to 3 weeks, an action expected to proceed without a formal deal. This news sparked an immediate relief bounce in mega-cap tech, highlighted by Meta's 8% climb over the last 5 days. While the headline index looks strong, the internal data shows a deep fracture. Ben from the Compound reports that the Magnificent Seven is actually down 14% so far this year, while the equal-weighted S&P 500 has managed to stay slightly positive. This divergence highlights a massive concentration risk. The market stability is still heavily reliant on just a few mega-cap names, finding relief from recent global pressures. While the headline indices are green, the underlying credit environment is starting to darken. Eurodollar University reports that Oracle is laying off thousands of employees to conserve cash as it grapples with mounting debt from its AI infrastructure build-out. This isn't just a corporate hiccup. It's a concrete proxy for a growing liquidity trap that's beginning to squeeze the shadow banking system. This liquidity trap extends deep into shadow banking, where major funds are now gating redemptions. UBS has frozen a €400 million European real estate fund for up to 3 years due to a lack of liquid assets. By contrast, Stone Ridge Asset Management has gated its consumer loan fund, honoring just 11% of withdrawal requests as fintech pressure builds. These moves signal that the era of easy borrowing is over, forcing institutions to prioritize cash preservation over growth as the cycle turns. While stocks rally, the labor market is sending a very different signal. Danielle DiMartino Booth reports that as of April 2026, the U.S. has recorded 13 consecutive months of downward labor revisions. This streak is unprecedented, and it actually exceeds the trends seen during the Great Financial Crisis. This downturn is hitting the real world. March job cut announcements topped 100,000, and that insecurity is changing how people spend. Core trueflation has cooled to 1.3%, signaling a sharp pullback in discretionary shopping. We're seeing a feedback loop, where layoff fears lead to lower spending, which then reinforces the economic slowdown. Inside the Federal Reserve, a new faction is pushing for an immediate policy shift. Forward guidance reports that Fed Governor Mirage dissented at the March meeting, favoring a 25 basis point rate cut to prevent over-tightening. Mirage argues that current policy is now modestly restrictive, estimating the neutral policy rate to be between 2.5 and 2.75. Beyond the internal debate, a structural trend is providing the Fed with unexpected room to move. A 15-month wave of deregulation is now expected to shave 0.3 to 0.5% off annual inflation. This persistent downward pressure creates a safety net, allowing the central bank to justify easing rates even if short-term energy prices stay volatile. In the semiconductor space, we're seeing a striking gap between fundamentals and how the market is actually trading. The Compound highlights that while Micron recently posted record DRAM growth of over 200%, the stock is stuck in a 30% slide. This divergence suggests investors are bracing for a macro downturn that simply hasn't hit the company's top line yet. Shifting to energy and the consumer, we're navigating a mix of genuine supply shocks and misleading data. Aswath Damodaran explains that oil prices surged nearly 50% in March as the Strait of Hormuz closed, a shift that effectively resets the global floor for inflation. On the consumer front, Joseph Carlson recently debunked a viral report claiming a $400,000 income is now required for childcare. He notes the study relies on flawed affordability metrics that create a sense of false financial despair, showing why it's critical to separate headline-grabbing numbers from broader economic trends. To navigate this earnings cycle, SMB Capital suggests watching early reporters in hot themes like fiber optics as leading indicators. This framework recently signaled a move in applied optoelectronics after peer reports showed strength. In the software space, the Compound is tracking Adobe and Salesforce as potential value plays. Both have dropped 50% despite reporting record earnings. Our ranked watch list for the week starts with fiber optics for momentum, followed by those software names, and finally Micron. The goal there is to see if record fundamental growth can finally halt the recent price slide. The Iran exit rally marks a major pivot today, but the tension remains with those subsurface risks. Between 13 straight months of labor revisions and the liquidity traps emergent in credit, the macro foundations are still under pressure. As we move forward, we're watching the fiber optics theme for the next set of earnings signals to see how this cycle actually holds up. You can find all our sources and data points in the description. Subscribe for your daily recap, and we'll see you tomorrow.